Welcome, welcome, welcome to another edition of Wealth Strategies Unleashed. And this week, I got to tell you, I am really excited. We are fortunate enough to have with us Marianne Bartels, the Chief Investment Strategist with Sanctuary Wealth. Marianne, thank you for joining us.
Absolutely my pleasure. Thank you for having me.
Hey, I don't know if you listen to a lot of podcasts. I whether it's in the gym or driving back and forth, always listen to a lot of them. And one of them that I've started listening to, the way they kind of started off is the host, if you will, goes and tells a little bit about the person. So I want to kind of hit some highlights, and I want you to give us kind of a little bit of a background about you and what you've done. I've been fortunate enough to know you for quite a few years, was an avid follower at our former firm, and you always shot it to us straight. And we're right, tons more than you were ever wrong, and it's absolutely fantastic to have you. What I kind of have down is that you've been doing this for 35 years, though you don't look like you must have started when you were 12, and you've been a huge influence on the industry in where it is and what you do. Number one is that when it comes to technical analysis, which is kind of a little bit of your background, I hope you share some of that with us, is technical analysis for 6 years and consecutive years, you were recognized as the best. And most recently by, make sure I get this right, by Wealth Management Industry, you received the Wealth Management Industry Wealthy Award, which is for RIAs in thought leadership. So we are clearly fortunate, and I know all of our listeners are going to be very fired up to have you. You're on Fox News, CNBC, Bloomberg, and frequently quoted in all of the market-related business things. So what did I miss?
Well, it happened towards the end of the year, so you may not be aware of it. I also won another important award by Business Insider. They nominated 11 people, calling them the oracles of Wall Street, for our predictions for the market for 2024, and I was one of their winners.
That is awesome. The Oracle of Sanctuary is what we should start calling you. Hey, what I thought we would do on this podcast is tell. There's some other things kind of about you. You've been doing what you do for 35 years. How'd you get started?
So this is a great story. I wanted to really be an actress on Broadway, to sing and dance. I thought that was a lot of fun. But my dad's baby sister, there were 4 in the family, but his younger sister, when she graduated from college, she didn't quite know what she wanted to do. And her uncle, my great uncle, got her a job on Wall Street in 1956. She was the first woman allowed on the trading floor at Ladenburg Thalmann at 25 Broad Street. Now, she turned down the job numerous times, but they kept calling. So she thought, she was a very religious woman. She thought it was a message from God that this is what I got to go do. She's like, all right, I'll go do this for a couple of years and I'll figure something else out. Well, a couple of years turned into, she didn't retire until she was 80. So she went there in her early 20s and she didn't retire until she was 80.
Wow.
She was a very famous technician on Wall Street. And for those of your clients that remember the show Wall Street Week with Louis Rukeyser, she was one of the regular panelists, and she was one of the elves that forecasted the market.
No kidding.
No kidding. So she wound up not having any kids. So she was very close to her 13 nieces and nephews, and I live the closest in New York. And we developed a very good bond. And when I was a teenager, she would invite me into the city. And of course, I loved the city, and we'd have lunch, and sometimes I'd get some great clothes. And all I had to do to listen to all of that is she would bring up these charts. And she would say, Marianne, you're a woman. I want you to understand finance. Don't know where you're going. And I want you to understand the markets. And she would just kind of talk. And I would roll my eyes, to be quite honest, after I left, because I was more into the show or wherever we were eating and what we were doing in the city than those charts. But after many years of her talking to me about markets, I wound up majoring in economics. And I used to go to her office, and I loved macroeconomics. And I'd go with this big story about the markets and the economy and stuff like that.
Right.
And then she would sit, she said, Marian, that's great. And she thought I did a terrific job. She said, but how are you going to make money for clients? I said, what? I said, you got to make money for clients? She says, you have to make money for clients. You've got to take this big story and you've got to figure out how that's going to impact the stock market and what you want to own and what you don't want to own. You want to talk about my eyes bugging out of my head, not even rolling?
Right.
I thought that was hard. And it was hard. It took me a long time to learn it, but she was my mentor. And she told me that technicians really weren't respected on Wall Street, but she said, this is how we make money. Uh, and when I went to Wall Street, she did not want me to be a technician because she didn't feel that they got the respect that they needed. I was into math and stuff like that. So I did strategy and quant. But when the opportunity came along at Merrill Lynch for me to run the technical department, I threw my hat in and I actually was appointed the head of the technical department at Merrill Lynch. The first woman to ever do that and the third person in the history of Merrill to ever run the department. It was Bob Farrell, Dick McCabe, and myself. Sure, those are some names you remember.
Sure.
It was a great honor to be appointed to that. But I had to go tell my aunt, who'd never wanted me to be a technician, that I was going to be a technician officially. And I was terrified to do that. And I took her out to lunch and I said, I have something that I have to tell you, and it's really going to upset you. And I'm very sorry about that. And I told her, and she just leaped for joy. But the other words out of my mouth were, you can't retire. I need
Right.
help. You're still my mentor. And that was a blessing for her because she lost her husband early on. He was only 65 when he passed away, and she was in her early 60s. And so we created an even tighter bond. And I did work with her for a period of time. And earlier in my career, she had her own business. But this even made a tighter bond for us. And when she got dementia and she didn't have any children, I opened up my home to her and I took care of her for her last 4 years of her life. And that was a great blessing, a truly great blessing for me.
Well,
And I think for her too.
I know she's up there smiling that you're carrying on her legacy, right? I mean, being a trailblazer and everything is just absolutely incredible. And I know that over all these years we've heard stories about Aunt Bernadette, and it's just it's pretty cool. So, hey, thank you for sharing all that, and it makes it even more exciting to kind of get into this because you're exactly right. Our job is to help clients make money, right? So when you think about 2025, and I know you've had, and a lot of our clients have seen kind of your outlook for 2025, let's specifically talk about at a high level, and then we'll kind of go and dig in. What are the things, 3 or 4 or 5 things that can go right in 2025?
Well, one of the things has already gone right. The Fed has already lowered interest rates by 1%, or also in terms of 100 basis points from September to December. Now, to be very honest, normally a Fed does not cut rates that aggressively unless we're in some kind of crisis. And we're certainly not in a crisis. So why did they do that? Well, number one, they felt inflation had made great strides coming down, not hitting their 2% target, but did go from 9% to a 2 handle, not
Right.
exactly 2, but in the high twos. They started to see some weakness in the employment or jobs, and they want to support jobs. So that's another reason why they cut interest rates. We've had reports since then. Inflation is still sticky, but still around that high 2% level. But we just got the employment report, and boy, it was gangbusters. It was a very strong report. So there were many forecasting that the Fed would cut rates coming into this year quite aggressively 4 times. That's down to 1 now.
Right.
But that's
right.
a good thing that we're getting rates down because you can move money, move liquidity. You can get better loans over time. Now, it hasn't helped the mortgage market because the mortgage market isn't priced at the short end of the curve. It's priced at the long end of the yield curve, the 10-year Treasury yield. And that's gone up and has not gone down for reasons I don't know if you want to talk about. I think they're good reasons, but because those rates haven't come down as aggressively, mortgage rates haven't come down. So that's kind of one of the stickier spots in the economy. So what else is right? Earnings. At the end of the day, when you strip out absolutely everything, geopolitics, Fed, deficit, any issue that you can think of, when you strip that away, really what makes stocks go up and down over time are earnings, right? Companies have to have earnings. And if they don't have earnings, their stock price goes down. And we have earnings, and we have very strong earnings, and we're projecting that earnings will remain strong coming into 2025. So we've got that right. We have the strongest developed economy in the world. Now, I used to say, you probably remember this. There's a lot of times I was on stage at our conferences, and I used to say, we're the prettiest house on the ugliest block.
Right, right.
We're still the prettiest house on the ugliest block. Yes, we have issues. But when you look at our economy, we're the best growing economy in the world, basically, in the developed world. And, China's a whole other basket. It might be growing a little bit stronger, but has a host of problems.
Right.
So that's another good positive, because how you create earnings is by growing your economy. So, inflation is down, companies are able to make money, the economy is growing, we're at full employment. When I was an economics major, both undergrad and graduate, and what my economics professor used to always teach me, you always have unemployment. There's always frictional unemployment. I would say we're low. We're not even at the natural rate of unemployment. I would say we've pushed that down. We're extraordinarily low. We're at full employment. People have jobs. The consumer spending. At the end of the day, almost 3/4 of GDP comes from the consumer. And the consumer is very robust in their spending. Now, they've been selective, and I would say the lower income constituents are struggling and can't necessarily spend on things that they'd like to. But what we would call middle to upper class are doing just fine. And, we like spending on, they call it experiences, right? And a lot of travel's part of that, air, hotels, eating at restaurants. So the consumer is alive and well. TV bothers me in the sense that they try to scare investors. When they say that the consumer's adding debt and it's at the highest level, I go, okay, so what? That's not
Really?
necessarily a negative. You really need to look at the year-to-year change. And then you need to say, can the consumer actually pay for this? Now, delinquencies have gone up, but are they at a level that are a warning sign that things can crumble? Not even close. So even some of the things that you hear on television, you really have to be very careful of, because I don't know why TV is this way. They have a lot more fear than optimism, unfortunately.
Well, they're like that because they need to sell advertising, and fear gets everyone
People like
involved, right?
fear.
That's
I
right.
don't know. We're attracted to it on some level. But I don't see a lot of fear in 2025. Now, that doesn't mean different things can't pop up. Doesn't mean we don't have challenges. I mean, to remind your listeners, we had 5 corrections last year. That's a lot of volatility.
Right.
And they're saying we're going to have volatility this year. No, we had the bucking bull already. Right. And that was
Right.
our thesis last year, is that we're going to have a great market, but it's not going to be an easy one. The bull market's going to buck, and it bucked 5 times, and it came into this year bucking. So it doesn't mean that the bull market can't have little setbacks. The question is, where are you going? Where's the target? And we're fairly optimistic, probably the most optimistic on Wall Street, of where the S&P 500 can be by the end of next year. And we're looking for 7,200 to 7,400.
Wow.
Now, to put that into perspective, that would be a 20% return. Now, most people think I've lost my mind. That's okay. I like it when people think that way. Because most of the time when they think I'm crazy, I'm right. Now, but things can happen to ruin my forecast. But why would I be so optimistic? Is that we've entered the field of the digital era. There's a chart that I use sometimes to explain where we are. In the 1500s, we were an agricultural economy. Our technology was a sundial. Very important piece of technology when you're in agriculture, right?
Right.
But then we created the steam engine in the 1700s, and our economy completely transformed. Huge innovation. In the 90s into 2000, we started, we went from mainframe mini computer to computers to networks, and then we were able to add the internet. And now here, the next generation is called artificial intelligence, AI for short. We have something that's called blockchain. Something behind the scenes that you haven't seen yet that's being developed is something that's called Web.3, which is the next generation of the internet. We have robotics. This is exciting. This is going to revolutionize how our economy transforms, not just here in the United States, but around the world. But here's the key factor. Who is producing this technology? Where are these companies? They're here in the United States. There's a handful outside of the United States. We are the creators, the inventors, the funding of all of this technology. We're the apple eye of the world, and money wants to come here. And that's strengthening the US dollar. That's good. We're still the reserve world currency. I can't tell you how many articles and podcasts I've listened to calling for the demise of the dollar, and here we stand, the strongest. The European economy is a mess. Their political system is a mess. You go to Canada, they have political problems. China is probably in a recession with deflation.
Right.
I mean, we're the apple eye. That's why I say we're the prettiest house on the ugliest block. And people want to come here to invest. And the title of my report this year, and I take this very seriously, I think titles and themes really set the stage. So last year was the bucking bull, and I thought people could really resonate with how the market would perform. So what am I seeing this year? I said, all that's new, that's old. I kind of flipped. They normally say all that's old, that's new. But I said, all that's new, that's old, because we have new technology. Yes, it's new, but it's old. Why? I went back, looked at the 1990s, which I just talked about, but also the 1920s. What happened in the 1920s? We went from horse and buggy to car, railroads, electricity, radio. I'm sure some people thought the devil was coming out of the radio, right? Think about it. Charlie Chaplin thought voice was terrible for film. He
No
didn't
kidding.
embrace voice right away. I mean, you laugh at that now, right? New technology can be scary, especially if you don't understand it. But our economy has always reinvented itself with new innovation. And we're in a new stage of innovation. And there's a group of us that struggle with us that happens to be more of the baby boomers. But if you look at this younger generation, they've grown up with technology. They completely embrace it. They're going to completely use it. And, for the baby boomers, the analogy that I use to help them embrace the changes is, hopefully you've seen Star Trek. Remember Kirk? Remember his flip phone?
Right. Yeah.
We used to have flip phones.
That's right.
You go to Star Trek: The Next Generation, you have these consoles that look like iPads, and they're touching them like iPads. Even the original Star Trek and Star Trek Next Generation had an earpiece that they talked into.
Right.
How many people are walking around with earpieces this day? You can't even, sometimes you talk to people, they don't even hear you, or you think they're talking to you and they're talking to the person in there.
That happens all the time. Yes.
So, and we may talk about this, we may not, but there's a lot of talk about Bitcoin. And is it a currency? Is it not a currency? Store of value? Is it all hype and a tulip story? But let's go to Star Trek. What was the currency on Star Trek? Did you ever see coins or paper?
No.
No, it was digital. And in a couple of episodes, they talk about credits. And the blockchain is a ledger of debits and credits. And Bitcoin trades on the blockchain. It can be used as a credit. Interesting, right?
Right. Yeah.
So, sometimes, our imaginations have really come through fruition in terms of technology. I mean, I can remember when Bill Gates said a phone back then we had flip phones, would have music, right? So I can talk, I can listen to music. I thought that was crazy. Now look at everything we do on a phone. I do all my banking. There's podcasts I listen to. I mean, if I lost my phone, I'd really be right. My
Yeah,
whole life is wrapped around my phone. And that's because we're digital now.
yeah. Well, I don't think a lot of people want to go through to admit that, but that's exactly the case. So if you think back, like in the '90s, right, we had the tech revolution and that tech bubble that ended up happening. Kind of started around 94, not actually around 95, kind of hit that bottom, and then it all started to go, and then we all know what happened in 98, 99, 2000, 2001. So we're at the beginning stages of this opportunity, and one of the things that I'd really like for you to kind of go through to explain, because I think sometimes when people are looking at the markets, they maybe lose sight of this longer term picture. Talk about what your long-term vision is, and then we're going to bring it back down here to 25. So your long-term vision, just to kind of paraphrase, and please correct me if I'm wrong, is that we started in a new secular bull market, which is a long-term market. You have secular bulls and secular bears. You think in 1966 to 1982, you think of 2000 to 2014 as secular bear markets, where in effect the markets don't really do anything. Then you go through these periods that the trend in that longer term is up, and it's up significantly. So where are we? We're clearly not in a bear market, but
so we're in a secular bull market for the S&P that started in 2013, and for NASDAQ, which I call the digital index,
right.
2017. So
Okay.
this is an estimate. My guess is that this secular bull will go out to the end of the decade. Ampy used to teach me that Wall Street was like a pendulum. When things went really bad, they're really bad. They're horrible. And then that pendulum starts swinging back. And I think we're kind of in that middle, right?
Gotcha.
And
Okay.
there's still a lot of doubt. There's still a lot of skepticism, right? And I think in the back end of the decade, we're going to go like this, and you wind up getting to euphoria where you can't find anything wrong at all.
Right.
And that will end the secular bull market. I hate to say it, unless something changes, secular trends just exist, but in the context of markets going up over time. Saying a secular bear doesn't mean that it goes down. It means we trade in a sideways, and we switch leadership.
Gotcha.
So the leadership that ran the market up in a secular bull goes into the bear market. And then other sectors and industries emerge into a bull market, but the market still has to digest and is just in a trading range. You can make money in a secular bear market. You just have to know where to be.
Gotcha. Yeah, that's the key, and that's where
That's the key.
the
Know how to make money.
so the thing that's important is that there is volatility in that secular market, right? And so you can have downtimes, and that's actually healthy. Do you see this market broadening out? The thing that you said is we went back-to-back years, and I was on a call with you earlier, I guess it was this week, back-to-back years of the markets going up 20+% are rare. Going up 3 years in a row, 20+% is even more rare. I don't know how you get rarer or whatever, right? And so talk about the things that to get us to that 20% that you kind of expect to have happen. Is it because we're not at that euphoria stage? What are kind of the indications that it's kind of all systems are go?
So we don't have euphoria. There's a ton of cash on the sidelines. There's still a lot of doubt, skepticism within the market. I don't hear people talking, hey, let's get invested in the stock market. I mean, there was one stock that maybe got a little hyped, and that was NVIDIA.
Right.
But the market in general, normally you have a bunch of stocks, and it's the market, and nobody can see anything go wrong. Here we hear, oh, the government can have issues. What about Trump, tariffs, the deficit? A lot of skepticism still in the market. So Other things that I look at is when we come to the major top end markets, everybody's all in.
Right.
And not only are they all in, it's levered. We
Mm.
leverage up because we're so confident. Not even close.
Yeah, there's
Not
tons
even
of
close.
cash, right? Tons of cash. What last number I saw was over $6 trillion in cash. I
It's
don't know if it's
seven.
still
It's
seven.
7 trillion now. And
That's
I
incredible.
understand that, because people are concerned. We have a change in administration. I understand because President-elect Trump, soon to say President Trump, um, he doesn't talk in a calm manner. How's that? That's a polite way of saying it.
Right.
He can ruffle a lot of feathers. And that puts people on edge. And that puts markets on edge. But I want to point something out. People keep talking about tariffs and how they're inflationary. Tariffs can be inflationary. They can be. But let's go back to the Trump administration where he did use tariffs. And let's see where CPI is, which is a good measure of inflation, when he left office. It was 1.4%. It was below 2%.
Right.
His tariffs did not cause broad-based inflation. Now you got to say, why? Because a lot of his tariffs were on China, and China paid the cost of the tariffs, not the people or the goods. So tariffs inherently are not inflationary. Or you can have select pockets, but it doesn't cause broad-based. So one of his policies that he had back then was on washing machines. I don't know why. I don't remember why, but he had tariffs on washing machines. So the price of washing machines went up. And of course, prices of dryers went up. But then they produced more and the prices went down. So it was not a sustainable increase in pricing.
So
So there's a
so
way to use tariffs, but we don't know. He's not in office yet. He hasn't done anything. So we're all sitting there, biting our nails. What is he going to do?
yeah.
I will tell you what based on what I've seen him do before and how I see markets behaving, I don't see anything detrimental happening this year with the Trump administration. The Fed, different story. That's on my radar, my risk for the year, right? My aunt always told me leave a window open, an escape hatch in case you're wrong. Right?
Right.
It's hard, but there are so many things to move markets. I mean, it's so easy to be wrong. And I'm very blessed that I get very good guidance where I can share that with everyone. And my track record has been astounding, and even shocks myself sometimes. Um, but I feel that, I receive some divine guidance when I'm looking at markets, and I just share what I see and what I feel. And then we see whether or not it materializes. And to say that the markets are going to go up another 20% is insanity, because if you base it on statistics, the probability of it is almost zero, right? Not exactly zero, but the last time we saw it was in the late 90s. We actually had 5 years in a row where markets were up over 20%. But two caveats. We had intra-year bear markets where markets went down 20%, but still closed up over 20%. And that was in 97 and 98. 97 was the Thai baht crisis. 98 was the Russia default. We had a hedge fund almost go under, which created a lot of major ripples in the finance system that needed help and bailout from the government and other investors, including Warren Buffett. But then again, they cut interest rates, markets closed up 20%. So it's not unprecedented, but it happened during a period of great innovation. And I think AI is going to have a more profound impact for a few reasons. Number one, let's go back to the 90s. How was the computers and internet funded? Through debt. We didn't fund it through cash, we funded it through debt. Today, all the major tech companies have clean balance sheets, and they're sitting on billions and billions of dollars of cash. We're funding this innovation through cash and not debt. We're also funding it through the private markets, and the private markets have a lot of cash. So the fundamental backdrop behind this is much stronger than what I saw in the 1990s. And when you look at the return on equity, which is you don't hear them talk about this on TV, it's more price earnings ratios. But really, to determine the return on your equity is to look at ROE. Warren Buffett always talks about ROE. Where are the best ROEs in the market? In the tech stocks or what we know is tech and tech related, building out AI, cloud computing, robotics, data centers. And now we're going to have to build infrastructure to support all of this, right? We don't have enough electricity. We're going back to nuclear. I know for some people that's a negative, but we're moving in that direction. There's a lot going on that I find is just fascinating. I really feel blessed to be living in this time of major transformation. We are on the cutting edge of really flipping this economy to be digital. And I understand for those that don't come from a digital background, it's scary, but this is happening. This is the movement. You know,
You may not
and
have a
I'm just
choice.
enjoying
It's
the
happening.
ride.
Yep.
And I think the markets will reflect that. And if you listen, I think it's also very important to listen to the comments of the CEOs on earnings calls. You know, NVIDIA created AI through their chip. They're the
Right.
first ones and the only one that have the chip that can compute AI, and their chip is called Blackwell. Great innovative company. And they created the chip to improve graphics, particularly for gaming. So you know they were gamers. Sorry, guys, but they were gamers. That's good. It's all good. But that chip, and for a short period of time, I was a junior technology analyst, and I worked for a great analyst, and he always taught me that there was a cycle. You improve your chip, you improve your hardware, you improve your software, and we're going into a software cycle now.
Gotcha.
Doesn't mean that chips are going to go down. I still think, you know, chips are going to be okay, but software didn't do anything really much last year. And I think we're going to go through a whole cycle of software, cybersecurity. You know, there's risk in everything, right? And, you know, any programmer will tell you every program can get hacked, right? You improve the hackers, you improve the security, and that's just the way it is.
Right.
So I think this whole period of innovation is going to create outstanding earnings.
So we know about technology and what's going to happen there, and how there's kind of this trickle down or flow through type of benefit to a lot of other companies. What other sectors or industries basically for 2025 stand a really good opportunity of having fantastic years?
So when I say tech related, some of the related stocks are in communication services, like your Googles, your Meta, Netflix, because Netflix is part of that story, although we don't think of that about it in terms of AI. Sit in communication services. Your Amazons, your Tesla sit in consumer discretionary. So those two sectors did great last year. They should, in fact, communication services actually outperformed the technology sector by
Really?
by a slight margin. So I think those sectors can continue to do well. I've liked, you know, industrials, all the infrastructure that has to be built. And now with the unfortunate events with the fires in California, think about the rebuild that has to come.
Right.
That's
That's going to
enormous
be incredible.
infrastructure. So I think infrastructure will do really well. The pockets that are not doing well are things like healthcare. Yes, I think the GPL-1, I mean, it got in there, and now how do you sustain it? I think a lot is in the price of the stocks. You know, vaccines were big during COVID, and a few years afterwards, the vaccine numbers are going down, not as many getting vaccinated. I think there's concern if Robert Kennedy gets appointed, what is that going to mean for the healthcare industry? So healthcare really looks like it's in intensive care and not getting out anytime soon, unfortunately. Consumer staples, because our economy is growing and the consumer is spending, discretionary spending is strong. Staples, meaning the things that you have to buy, like things like food, snacks, those stocks aren't doing that well. Utilities do well, particularly those that are leveraged to natural gas, those that, because with Trump coming in and LNG exports expected to pick up, more favorable regulation. So you're seeing pipelines in gas and energy, you're seeing pockets in utilities, but particularly the ones that are independent and leverage to nuclear are doing very well
Yeah.
because that's considered a new growth spot.
You
So
know,
there's a lot in the market that's actually performing well, but it's in the large cap space, or what I like to call mega cap. There's large cap and then there's mega cap. And it's really this mega cap space that is doing, I think, the heavy lifting for the markets.
what about being in Houston? We don't have a conversation that doesn't revolve around energy. Now, you talked a little bit about LNG and that kind of stuff, but specifically oil. The thing that's kind of crazy to me is that during Trump 1, green energy outperformed big oil. And that actually makes a lot of sense because energy prices came down. The opposite happened during the Biden administration. Now we're on the verge of Trump 2. What about your major oils and the big oil and big those companies? Is there opportunity there or?
So here's the positive about energy. Great companies, great balance sheets, and the large ones have great dividends and very well supported through cash flow. So if you need to generate income in a portfolio, I think these are great stocks if you're looking for dividends. But I'm not necessarily great stock performers. They're not making the earnings that these tech companies, right? It all boils down to earnings and earnings growth.
Right.
NVIDIA had a 100% growth rate in its earnings. I mean, it's insane. And very rarely even happens. How does energy compete with that when oil prices are stuck in a trading range? They can't. So they're value stocks, but I don't see them participating in a big way. I actually think energy will probably be a big winner in the next decade. But right now, natural gas looks to be breaking out. And I can actually target nat gas getting up to anywhere in a range between $6 to $8,
Wow.
which would be extraordinary. The pipeline stocks are doing really well. MLPs look really interesting with their dividend yields. So there's pockets within energy that I think are doing very well, but with the big majors really not doing very much in terms of price performance, the sector really doesn't look like it's doing very well. So you got to dive down into the energy sector. So I think for 2025, the story in energy could be natural gas
Gotcha.
and LNG, the combination.
And right here in Houston, there's a lot of it, right? So a lot of people that are involved in that. It's interesting. Just to kind of wrap this kind of up. I remember back when I was in college. I don't know if you ever heard of a guy named Bob Kippis. Used to run a mutual fund, and was kind of this aggressive growth. I think it was called at that time the AIM Aggressive Growth Fund. And he came in and talked, and there were a lot of people who were much, much smarter than me that were asking him questions. And after the third or fourth kind of really technical type of question, he turned around and wrote on the board, earnings. And he turned around and says, that's your answer. The next question that came up, again, something very, very technical, talking about all the different ratios and everything. And he turns around and goes, the only thing I care about are earnings. You only make money if companies are making earnings. And so it's kind of interesting to see how history tends to repeat itself. This time it's not different from Bob Farrell, right?
It's not different. Wall Street's really not that hard. I mean, it's a new language. You have to learn some terms and stuff like that. But, there's basics to Wall Street. And I think my aunt trained me so well. I mean, she's passed, but I am just so grateful because the education that she gave me, and she had to learn a lot of this on her own because there really weren't a lot of mentors for her at the
Right.
time. And markets repeat cycles. And what I've come to believe, markets repeat cycles because of fear and greed. And until we remove this fear and greed, we're going to have these great cycles within the markets. But when you go back and you really study it, and I did a lot of quantitative analysis modeling, reading going to universities, reading the professors' understanding of markets. At the end of the day, you need earnings. It's
Right.
true. Now, there's valuation, and you're going to hear about valuation all the time, especially on television. I will honestly tell you, there's not a model in the world using a PE that predicts markets. Markets are cheap and markets are expensive.
Right.
And here's where people made the mistake. If you go back to 2023, people were concerned that there wouldn't be any earnings. So they thought the market was expensive, but there were earnings. It's very hard to predict earnings. It is hard. It's not easy. But at the end of the day, if you really do your homework, you understand how an economy works, you listen to what corporate CEOs are saying, you have a good sense of where the earnings are going to be.
Right. Marianne, I can't say thank you enough. I want great insight. Absolutely love learning about what can go right this year. And quite honestly, I mean, I think in listening to you, how could you not be excited about where the opportunities are? To all of our listeners, I want to say make sure you tune in next week because we have Marianne back. You're going to love this next podcast just as much as you love this one. Marianne, again, thank you very much for taking the time.
You are so welcome, and thank you for having me.
And we'll see you all next week, and see you next week, Marianne.
The information contained herein is intended to be used for educational purposes only and is not exhaustive. Diversification and/or any strategy that may be discussed does not guarantee against investable losses, but are intended to help manage risk and return. If applicable, historical discussions and/or opinions are not predictive of future events. The content is presented in good faith and has been drawn from sources believable to be reliable. The content is not intended to be legal, tax, or financial advice. Please consult a legal, tax, or financial professional for information specific to your individual situation.
This work is powered by Concenture Wealth Management, registered representative of Sanctuary Securities, Inc., an investment advisor of Sanctuary Advisors, LLC. Securities offered through Sanctuary Securities, Inc., member FINRA, SIPC. Advisor services offered through Sanctuary Advisors, LLC, an SEC registered investment advisor. Concenture Wealth Management is a DBA of Sanctuary Securities, Inc. and Sanctuary Advisors, LLC.